The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and welcome to Squawk Box Europe. I'm Karen Cho and these are your headlines. China eases rare earth controls and ends a series of chip sector probes after its deal with the US, as President Trump signals continued opposition to exports of Nvidia's best chips.
We will let them deal with Nvidia, but not in terms of the most advanced. The most advanced, we will not let anybody have them other than the United States.
Crude prices extend gains after OPEC Plus says it will suspend further output hikes for the first quarter of next year. Ryanair delivers a first-half profit beat and forecasts stronger passenger traffic as CEO Michael O'Leary lashes out against UK Chancellor Reeves over her tax policies.
You have the laggards like Germany, France and Reeves here in the UK remarkably talking about wanting growth and yet increasing taxes on air travel on an island on the periphery of Europe, which again confirms my belief that Reeves hasn't a clue how to deliver growth.
Well, I hope you spent the weekend pondering because there was a lot packed into last week for the market to digest. We had all the trade news across the Asian markets. We had a ton of big tech earnings with a truckload of capex spending still on AI investment. And of course, we had the Fed with a rate decision reducing interest rates. So we're picking up on a lot of those themes. A lack of data now starting to catch up with the US Federal Reserve and expectations now being wound back around a December rate cut potential. The ADP, we're now reliant on private data, so the market's going to be looking at that jobs report. And of course, more tech earnings are going to be crossing this week. It's going to be AMD, another big challenger to the Nvidia race. We've got Qualcomm also in play when it comes to chips. They're going to be reporting this week. But let's just pick up on that top story now around trade, as the White House has announced that Beijing will suspend the implementation of additional rare earth export controls. China will also terminate all investigations into US companies in the chip supply chain. The agreement comes as part of the trade deal between the two countries, which was announced last week. Washington said it will also pause some of President Trump's so-called reciprocal tariffs on China. Dutch chipmaker Nexperia says it welcomes recent statements from the US and China that would see it being allowed to resume exporting its chips. China's Commerce Ministry on Saturday said it will loosen restrictions on the export of Nexperia chips for eligible cases, while considering the safety and stability of global supply chains. Speaking to CBS, President Trump clarified whether he would allow US chipmaker Nvidia to sell their most advanced chips to China.
No, we won't do that. But
it's not on the table at all.
We will let them deal with Nvidia. Nvidia is the prime company in the world for that. And we will let them deal with Nvidia, but not in terms of the most advanced. The most advanced, we will not let anybody have them other than the United States.
Because then they would win the AI race.
Well, they wouldn't win it necessarily, but they would certainly have an equal advantage.
Let's take a look what the markets have been doing with all of this news flow. It was a little bit of a bounce on that Friday session. So let me throw over to Ritika to run us through how the Asian markets have started.
Yes, Karen. Well, it looks like it's shaping up to be a pretty global rally across the board. We start over with the US, with Asia, I should say, where we're seeing a strong rally there. Particularly, you can see the Kospi up some 2.8%. That has been led by some of those tech stocks, Samsung in particular. And of course, we had a lot of optimism last week on the back of those several deals that we saw from the chip maker Nvidia. You see the Hang Seng them up some 1%. There was a bit of subdued data from private sector factory activity that did slow down in the previous month, but really broadly taking their cues over from the US. Because if we flip up the board and see, we had a strong session on Friday. The S&P 500 closed up nearly 0.3% higher. It was the outperformance, though, that we saw in the Nasdaq, up some 0.6% higher. This was thanks to Amazon with another strong set of results. Those shares really surging, that we saw that give a big gain. If we take a look at the month in the US October. We see, again, a really strong picture with the S&P 500 up some 2.3%. The NASDAQ up nearly 5%. So investors ignoring the volatility and looking past that and focusing on corporate America and the profits. But there is a question about where stocks go from here, because we have seen some narrow breath, a concentration on big tech. Let's focus on what's happening over here in Europe this morning. We see adding to the gains that we've seen in the US and Asia, so taking their cues from there. The FTSE up some 0.1%. The Bank of England decision is going to be in focus, of course, this week. The CAC 40 up 0.1% as well. Let's take a look at Europe over the month of October, where we see again some strong gains. The FTSE 100 outperforming, up some 4%. The CAC 40 up nearly 3%, despite what's been a lot of volatility on the political front there. So investors looking past that for now, focusing on some of those earnings that we continue to see trickle in. Karen?
Ritika, thank you very much for that. Speaking of the earnings, we're watching out for a bunch of them here in Europe, but also stateside throughout the week. Palantir, don't forget, it's been the stock that's run up very aggressively around the AI story. It will report later today. Or tomorrow, we'll be watching out for the likes of BP and Aramco, so we'll read into the oil space. Novo Nordisk will report on Wednesday alongside BMW, and on Thursday we get numbers from AstraZeneca, Rheinmetall and Commerzbank as we round out the week looking at the banks. Well, Marcus Weyera joins us now, Senior ETF Investment Strategist at Franklin Templeton. Marcus, thank you very much for joining us.
Good morning, thank you.
It has been an incredible run when we take a look at some markets. To me, it was the NASDAQ FTSE twin trade. Very different markets, but both were real outperformers during the month of October. What do you make of some of the momentum we've seen in technology, but also some of those diversified cyclical plays here in the UK?
So I think the technology play is obviously continuing. We saw last week and going into this week, even Qualcomm is coming on Wednesday, I think. But the results that we've seen so far from the mega caps and the technology players have been outstanding. We see some more breadth in Europe, but in the US as well. So that's a positive sign. What fuzzles us a little bit is the strength in the FTSE 100 compared to the smaller caps. If you consider the dollar is down, so the pound is up. Obviously, it's not a perfect correlation, but usually you would expect in such a year to do small caps, for small caps to do well compared to the large caps. That hasn't played out. And now obviously we got the Bank of England coming as well. I would say that small caps have a bit more room to catch up.
Yeah, we saw that on the Russell 2K. There was a little bit of nibbling, but it wasn't as strong as the technology trade.
It has actually, in the last couple of weeks and days, I mean, mega caps have really driven the market compared to the Russell again. Right?
Yeah, it's interesting, isn't it? And we had all the big tech numbers, but that said, it felt as though investors had a digestion issue with the amount of capex we're hearing about from Meta, from Microsoft predominantly. That said, if you rake back over Microsoft's numbers, we saw very strong growth. I mean, revenue was up, cloud services were up, fueled by the AI spending. So was there anything to worry about in terms of the capex story for you around technology names?
I mean, the capex is covered by the earnings and the cash flow for pretty much every single one now. Okay, Meta is taking on some debt. I think that is a bit critical to market because it's really the first one. But again, you mentioned it, the underlying numbers are really, really strong. And so we think that those companies, even with the high capex spending, we're not going to see for years how that's going to play out because their underlying business is so strong. So they don't need to generate returns on that capex immediately. But we do see a little bit of a bifurcation now in terms of, I mean, we saw Meta sell off quite aggressively on that one day. It's bounced back. But I think the market is going to look more discerningly now at the company reports rather than just playing the AI trade as such.
How do we think about positioning, though, going into year end and into next year? Because it has been a fairly significant year for technology. But the Nvidia story that we heard from Jensen Huang the other day is that we're just at the foothills of a 10-year investment cycle in AI. If that is the case, then it means more money could find its way off the sidelines going into 2026. So what do you see in terms of positioning around some of those big tech names for next year?
Actually, we see, and that's both anecdotal evidence from when we speak to investors on the ETF side, especially from the more tactical medium-term trade point of views, but also if we look at the data, exchange data and other stuff, we see that investors are actually quite cautious. So everyone is talking about a bubble currently. Going into year end now, November is traditionally the strongest month. Now, after the earnings season, we may get a little bit of a lull and some profit taking. But towards the year end, there's going to be a lot of discretionary investors who are on the sidelines, have been for most part of the year, at least since April, and they need to catch up. Now, we're going to have to see what happens next year. Next year, maybe a slightly different regime in terms of Fed. Now, we had the comments from Powell that December is not a foregone conclusion. The market is pricing, I think, 3 to 4 cuts for next week. We think that's a little bit too dovish. But I think for the rest of this year and early next year, it's going to be quite positive.
These themes really play into each other, that you've got a Fed cutting, it fuels a super cycle around AI and technology spending. You mentioned catch-up, and to me, when I look at what's been placed in terms of the AI trade so far, it's been really early on. It's been around the chip companies, the picks and shovels, the hyperscalers, so those who are building the supercomputers to plug into. It's been around utilities, those who are going to power the AI trade. What's been missing is companies further down the track. And it feels as though if a company pops up on earnings day and says, oh, we've had a terrific improvement in our revenues thanks to AI spending. I mean, Caterpillar was a great example of it over the earnings season. Then investors scramble to catch up because they've missed that story. They don't know how to play the AI trade. They're still learning it. So a company can surprise them with an earnings report because they are actually part of this AI story. And there are some are saying, look, beyond just these Mag 7 stocks, for further filtration of the AI story beyond. And then you see catch up in those names. So could next year actually be that year of surprise where we learn more about what are truly AI companies and who could be perceived as an AI winner?
I mean, at the moment, if you look, it almost feels like you got to just put AI in your report, right? You have nothing to do with AI and your stock will go up just because of that. Again, I think we're going to have a more discerning year next year. And AI is obviously, and we've seen it already, can be a great productivity boost. But I think there's voices out there, and I'm not the expert on that, but there are voices out there that say we haven't seen enough of a productivity boost to justify all of that. So I think really the litmus test will be again in the numbers. And that can be, quite a bifurcation in terms of which companies are to do well.
Yeah, I take your point on that. I want to move on to the banks, and you mentioned the Fed. The expectations are now declining going to year end as to whether we get a rate cut. The banks, though, down 4.5% for the month, which is unusual when you have a little bit of a relief on the interest rate story. So how are you perceiving the way investors are viewing the banks?
I think there's a little bit of profit taking there going on the back actually of relatively strong numbers. If we look again at the US, banks' margin have held up quite well. The provisions are quite strong, so indicating also an economy that is still doing well. But they have rallied a fair bit as well. And so I think there's some profit taking. But overall, I think if you look at the capitalizations in the banks, fundamentally, they're still to do quite well. I would assume that banks are also not going to be the strongest sector going into year end.
The labour market data seems to be catching up with us now. I mean, we've been weathering the lack of data for the Fed being able to make its decisions without the official data with the government shutdown. But now we're not getting any of the job numbers that are rolling across this week. How does that impact market psychology?
It's difficult to say. I think now this week also there will be important data out that we may or may not get. We may learn it on the day effectively. I think on the day when we miss the data, it doesn't affect it. But what we're concerned a little bit about is going forward, if there's then a slew of data or secondary data that people are stitching together from other data that we have, and then come to a conclusion, that's actually looking very different from what we expected. At the moment, we're flying blind. Good stuff that we have the earnings season currently, because that keeps the market focused on other things. But as that goes away over the next, I would say, 2 weeks, it may get a little bit more tricky in the markets.
Yeah, no job openings, no non-farm payrolls, so just down to the ADP. When it comes to the UK, there's a different problem when it comes to clarity for a central bank, and we are shaping up for a potential BOE rate cut this week. That said, with so much news flow about what the Chancellor Rachel Reeves could do in the upcoming budget this month, what does the Bank of England do in that context for the UK economy?
It's a shame, right? We got numbers here, but they're not looking too good.
Exactly.
So we think that the bank is going to hold. Obviously, I think markets are pricing about 30% probability of a cut, maybe 40. We don't think, unfortunately, that they will not cut. So it would probably be necessary because we know that there is going to come more fiscal drag out of the budget later. We just don't know exactly how that's going to look like. But it could end up looking like a little bit of a policy mistake in hindsight. The inflation is still high, 3.8% here, so we are way above target. But at the same time, the consumption spending in the UK is the worst in G7. So I think there would be a lot of data points for the BOE to actually justify a cut. Alas, they're most likely not going to do it because inflation is still sticky.
We know it's going to hurt when it comes to the budget. We just don't know which part of the body is actually going to be inflicted upon when it comes to the damage. Yeah. I want to ask you about the diversification trade. We touched on it briefly around the UK because it does feel like a diversifier away from the big US tech numbers. That's why the FTSE is rallying. But other parts of Europe rallied over the course of this year too. What do you make of how that trade could unfold for the rest of this year and going into next year? Because it was really a favoured trade around defence and infrastructure for a period of time in 2025.
Yeah, I think obviously going into next year, a lot of that fiscal stimulus is going to come through. So then people will look at the macro data and at the, again, earnings, how that filters through. Not much has come through yet because it couldn't. So we always thought it would be a story for 2026, probably more the second half rather than the first. There will be some anticipation of that. For the end of this year, though, I think with that really sharp rally that we've seen in the US, and I mean the US now based on a dollar, currency adjusted performance, it has made up all of the underperformance that we've seen until April. So I think there will be more chasing of US stocks for the rest of this year. And then next year, potentially, as the Fed may hold rates more than people think, and then the fiscal stimulus coming into play really in Europe, that could be a time for the diversification coming even more into play than this year.
It does feel as though it's very last minute chasing that fiscal trade in Germany, that it really is the US narrative still. Marcus, thank you very much for getting us warmed up on a Monday morning. We do appreciate your time.
Thank you very much. Have a good
That's
day.
Marcus Valero with us, the senior ETF investment strategist, Franklin Templeton. Well, coming up on the show, OPEC hikes output in December, but presses pause on future moves. We'll hear from key voices in the sector. Plus, Ryanair profit beats expectations in the first half, with the budget carrier seeing strong demand. We'll bring you the market reaction. And we'll break down the impact of tariffs on the drink sector with the VP of European Corporate Ratings at Morningstar DBRS. 8 OPEC Plus producers have agreed to pause output hikes in the first quarter of next year amid fears of a supply glut, with the group citing seasonality for the move. The producers also agreed a modest production increase of 137,000 barrels per day for December. Dan spoke to the CEO of Baker Hughes at Opec in Abu Dhabi and asked about the investability of the industry and whether it can pivot towards the future of crude, with crude hovering around $60 a barrel.
When you look at the longer term, there's going to be an all-of-the-above strategy relative to the energy mix that's provided. And it's going to be an aspect of oil, it's going to be an aspect of gas. And so I wouldn't frame it directly correlated just to the oil price. Also, when you think about the grid and the infrastructure, what you are seeing is a move towards distributed power generation. And we think that's a theme that's going to be very much thought of in the short term, as then the larger infrastructure comes into place. So what we're seeing is actually the investments are there. You've got the major players, the hyperscalers that are willing to make the investments. And also from a capital markets perspective, the infrastructure funds are willing to make the investments as well.
Eni has announced a joint venture with Malaysia's national oil and gas company Petronas to consolidate upstream assets in Southeast Asia. The new entity will be equally owned by both firms and manage a portfolio of 19 assets. Let's get out to Dan. He does join us from Opec in Abu Dhabi. Dan, it is a fascinating backdrop as you talk about energy transition with a slightly lower oil price at this stage. How is that resonating as companies plan for the future?
Well, Karen, as you know, in Adepec's gone past, the conversation on the ground here would consistently be on the energy price outlook, what's happening with the price of oil, and how OPEC is ultimately managing this market. Well, I think it's fair to say the conversation here has firmly shifted away from volumes and barrels, and now it's about how this industry can pivot in order to essentially power the artificial intelligence demand that we are now seeing globally. So right now the energy industry is actually calling for more and more investment. A familiar refrain from this part of the world as we see the demands of AI and compute capacity continuing to build out. It's clear that a lot of the operators that I've been speaking to on the ground here are confident they're going to be able to fulfill that demand and provide the energy and the electricity that the world is going to need in the future as AI demand continues to scale. But of course, that is going to require additional investment, which is something that they have been talking about here. Speaking of investment, you mentioned Eni, of course, this major announcement coming out earlier today. Eni and Malaysia's Petronas setting up this brand new deal, setting up a JV called NewCo. It's a 50-50 partnership. It's going to ultimately combine 19 upstream assets across Indonesia and Malaysia, a key step here after a framework was agreed earlier this year. I spoke with Eni's Claudio Descalzi, and he says this tie-up is aimed at unlocking long-term value, blending European and Asian expertise. We spoke earlier. Take a listen.
We talk about a company that will start producing more than 300,000 barrels per day. We talk about gas. And in 3 years is going to produce more than 500,000 barrels per day, 3 billion of P1 reserves, plus 10 billion of contingent exploration reserves. We have a huge campaign of development, more than 8 fields to be developed in the next 3 years, for about $15 billion of investment. And then we have all the explorations, more than 15 wells or 18 wells or new exploration wells. It's more than a joint venture. First of all, it's a company. For us, a deconsolidated company. So it's self-financing through the cash flow they produce. That is a way to allocate capital because we have found a lot of exploration reserves in the last 15 years. Then we have to develop, but you have to invest. So we find a different kind of economic model with this, what we call satellite model. So entities that are able, through their own cash flow, to develop themselves, get debt without really relying on our debt. So our financial KPIs remain very good. Our balance sheet's very good, but at the same time we can increase through equity, not in a line-by-line exercise on the balance sheet. Through equity, we can increase our revenues and our cash flow from operation. And we can work in parallel, developing different fields. It's not the only case. We do that in Norway with Bar, Ithaca in UK, and Azul in Angola. So it's a model that can really give the right value to our exploration discoveries. It's strategic because of the area. The area is really hungry of energy, and we have existing facilities. That means that we can be very fast in time to market. And it's a joint venture between two countries, so there is also a geopolitical aspect that is not marginal.
Walk me through the trends that you're seeing in the Asia markets right now, because I think the deal also reflects the growing demand that you speak of, but also the investability of this part of the world right now.
I think that the two things are linked. They need energy, they are growing, it's a very vital market, and so it's one of the best places where you can invest. Clearly, I talk about Middle East, I talk also Asia in general, the eastern part, because they are growing a lot. And when you think about artificial intelligence or the critical minerals, so the new form of energy that require a lot of base loads. Gas is the first choice. Nuclear with nuclear, but gas is good because it's less. There is less emission at the end of the day, but also is very flexible. You can switch on, and switch off very rapidly. Nuclear a little bit less. Clearly, with renewable, you cannot do that. So you need a mix of energy, and we are developing also renewables in this area, but it is a mix of energy. But the market is very, I think, is really demanding a lot of energy and is growing. So, and is attracting a lot of capital. They are very pragmatic. There is a huge amount of population. The demography is clearly a very strong point. So I think that is the right place where you can put your money. And from our point of view, we discover a lot of reserves. And that is a good point, because we can give value to our reserves because they need it.
Claudio Descalzi there weighing in on this major new partnership with Malaysia's Petronas. I also had the opportunity to speak with Amos Hochstein earlier today. He is, of course, from TWG Global, but also served as a former senior advisor to President Biden. We spoke about the geopolitical implications of this growing race around AI and, of course, what it means for the energy industry as well. Listen.
One of the challenges is that software companies or intelligence companies are not power people, they're not energy people. So the realization that's happened over the last 12 months, I think, is that the tech giants have realized we need to understand power. So I think where the money, the smart money can go is investing in building out power generation and figuring out how to do it differently. So part of it is on the grid and some of it's going to have to be behind the meter, and to be able to connect natural gas and renewables and battery storage and having that combined power. There's a lot of area to invest there if you can make it seamless and efficient for data centers. It's also going to cost more, and obviously the tech companies are willing to pay more. And so we have to be mindful that we don't invest in the power sector in such a way that increases prices for ordinary consumers that will create a backlash that we're already seeing in the United States against data centers. So we have to pour a lot of money into it, but it's incumbent on us to do it really smartly. If we do it wrong, we're going to get a public reaction against everything.
Amos Hochstein weighing in earlier. And just with regards to the market dynamics right now, of course, we are looking at oil prices a little higher today off the back of OPEC's decision to add more barrels in December. CNBC sources saying that decision to pause in Q1 26 is not based on politics. It's basically following what is a decision that was similarly made in Q1 of 2025 as OPEC looks to essentially try and iron out the seasonality in demand. Also, ADNOC's Dr. Sultan Al-Jaber weighing in a short time ago in his opening address here, saying that oil demand is going to remain above 100 million barrels per day beyond 2040. He says increasingly used not just for mobility, but for more and more materials as well. So even though the conversation here on the ground is firmly focused on the energy AI nexus, of course, fossil fuels and the outlook for oil still closely watched as well.